Hi, everyone. Thanks for joining and welcome back to Wall Street Silver. Joining us today is my good friend Adrian Day from Adrian Day Asset Management. Welcome back, sir.
Well, thank you for having me, Ivan. Good to see you again.
Yeah, always a huge pleasure having you come down to Wall Street Silver to talk about everything that's happening in the markets. I wanted to first start off with our huge topic, gold and silver. You know, a lot of people online are speculating and talking about gold is just not going to stop. It's just going to keep going from now till the end of 2024. What is your outlook for precious metals? And first of all, we'll start with gold.
Yeah, it's always a little dangerous when we think it's not going to stop.
Yeah, that's true.
Because inevitably markets, well, as JP Morgan famously said when he was asked, well, what do you think the outlook for the stock market is? He said it's going to fluctuate.
Yeah,
Um, I mean, there's no question in my mind that we've definitely got very strong forces that are driving gold upwards. And that trend is upwards. Whether we get a correction or a pullback at some point, that's a different issue. But
right.
the trend is definitely in the right direction. And the really powerful thing to me is not so much who is buying gold, but who is not buying gold.
Right.
That is virtually every individual and institution and mutual fund in North America and in Europe is not buying. That means that there is just tremendous, shall we say, buying power on the sidelines.
Why do you think they're not buying right now while you see central banks buying a ridiculous amount? China's buying lots. Why do you not see these hedge funds and institutions gobbling up gold? Like, why not?
Yeah, well, I think it's reasonably simple. I mean, if you take a snapshot of where we are today, you look at a reasonably strong dollar, come off a little bit in the last couple of months, but a reasonably
Right.
strong dollar, you see reasonably high interest rates and interest rates that have moved up aggressively. You see a Federal Reserve and a European Central Bank that don't appear to be in a hurry to cut rates.
Right.
And you see an economy that is still on the surface doing well, and you see a stock market that is still moving up. Well, that is a scenario, frankly, where you sell gold. You certainly don't buy gold in that scenario.
Right.
And so for investors, this doesn't appear to be a great time to buy gold. I mean, I'll argue with that,
Yeah.
but and as we've discussed before, and as everyone knows, the central banks are buying for other reasons. They're not buying gold because they think, wow, it's a good investment right now.
Right.
Interest rates might come down. They're buying gold for other reasons, so they're price agnostic. So that's why I think the main reason that Western investors, large and small, have not really moved into gold. And that's even exaggerated when you look at the gold stocks,
Right.
because if interest rates are high and the dollar's strong and the stock market is strong, you don't buy gold stocks.
Yeah. And you're looking at everything that's happening at the Federal Reserve, and people have been speculating online about, oh, in the beginning of 2024, they're saying for sure they're going to cut rates in 2024. Now, almost halfway through the year, they're saying, they don't think the Fed is going to be cutting rates anytime soon. Do you think they need to see some type of hurt in the stock market, like either an AI collapse comes or something happens in the stock market, then the Fed will have to step in? Or are they just waiting for that moment?
Yeah, I don't think it's the stock market. I don't think Jerome Powell and the Fed is going to change direction because of the stock market. I mean, other than a 1929 collapse.
Right.
And I don't think they care too much about AI if NVIDIA falls 30%. I don't think that does it. What will do it is one of two things, in my view. Either meaningfully higher unemployment,
Yeah.
and I mean, as we've discussed, I think the unemployment rate number in the US grossly under understates the real pain in the employment picture. with people having two jobs, with people having, part-time work instead of full-time work, and
Right.
driving Ubers instead of, working in an office in white collar work. But it understates the difficulties in the employment market. But nonetheless, I think a significant move up in the unemployment rate will get the Fed, will certainly tilt the balance,
Right.
right? It will tilt the balance. Now, Jerome Powell himself said last month, he said, I'm not talking about 1/10 or 2/10 of a percent. So we're talking about a steady, meaningful increase. But I don't think even that alone, that will tilt the balance. The other thing, of course, will be institutions failing. Another central bank, another regional bank failure. And that looks as though it's getting closer, doesn't it?
It does, yeah.
Banks are beginning to write down some of their loans, and other banks, even more importantly, significantly, not writing down loans, but they're not getting paid on. So it's just pretend and extend. So that, I think, will cause the Fed to, something like that will cause the Fed to change direction. But, as we've discussed, and as everybody knows, the Fed really has a dilemma here,
Right.
because they should increase rates to kill inflation. I mean, even with the PCI numbers, or, the core PCI, let's make it as narrow as we possibly can. The core PCE that came out, okay, so it was 2% month on month. That's still 2.8% year on year. And even if you extrapolate the 2% going forward, that's 2.4, that's still 20% above their own arbitrary artificial target.
Yeah.
But nonetheless, they look at that, and but I think a lot of people see that inflation is actually higher than that. And so you need to raise rates. Bill Dudley, the former New York Fed president, made the point this morning. You need to raise rates in order to kill inflation. But they know full well that will hurt the economy, particularly the lower 50% in terms of income and assets. And I think more importantly, that will potentially cause disruption in the things we're talking about: commercial real estate, regional banks, but also just make the US federal government's problem in financing debt,
Right.
much more difficult. Because, even if rates stay where they are, the amount of money that goes on servicing the US debt, we're talking about the US here, but services US debt, is going to increase, even if rates just stay where they are. Because the 5-year notes that they issued 4.5 years ago
Yeah.
were issued at under 2%. When they come due, but US government is not paying off any of its debt. I mean, I hope everybody realizes that. So every time,
So what do they do with it? If they're not paying it off, do they just push it down the line?
you just roll it over.
Oh, you roll it over.
Yeah, and so the 5-year note that was issued, 4.5 years ago at less than 2% is going to roll over at 4.5 or 4.75%.
Right.
That is a meaningful increase, and you multiply that by all the 3-year notes and 5-year and the 10 years issued 8 years ago.
Mm-hmm.
That means that if rates just stay where they are over the balance of this year and next year, interest service, the service on the debt, is estimated to almost double from here, even if rates just stay where they are.
And I read an article this week that it already passed the military, like the debt servicing already passed the cost of all the military expenditure.
It's higher than the military, and also just that was last month, and now this month it's past Medicare. So
Jeez.
it is, depending on how you break the budget down into what components, it is the largest single component in the budget, and it's a component that really isn't discretionary, and it's only going to get worse if rates stay where they are or anywhere close to where they are. Because even if they come down from 5 to 4, That's still more than double what the notes were 5 years ago. And of course, that's why Janet Yellen made a trip to Beijing, pleading with China, please buy our bonds. Truth is, China has no particular incentive to buy US bonds right now.
They just sold a ridiculous amount of I don't know if it was US dollars. I read it in the articles this week. They were selling either I think it was US bonds or US dollars or US debt, but they were just
Right.
offloading a ridiculous amount.
Yeah, China is selling aggressively. Russia is already out, of course. Of the big three, China, Russia, and Japan, Japan is the only one still buying. And frankly, last month they bought a lot, or the last month that was reported, I think that's probably April. Uh, yeah, April. They
Right.
bought they bought a lot. But I think that's going to change as I mean, when you think about it, 2 years ago, 3 years ago, 4 years ago, you're a Japanese insurance company, pension fund, institution. Do you buy a Japanese bond that has a negative yield, meaning you're guaranteed to get less back when it matures, with the yen falling, or do you buy a US dollar bond at 3, 4, 5%, where the dollar is strong?
Oh,
Well,
the
that's a
US.
no-brainer.
Yeah, yeah.
That's a no-brainer. But as interest rates in Japan move back up and are now positive, the 10 years like almost 1% now. The yen, after having fallen, is just beginning to slowly appreciate a little bit. That's an open question as to how far it goes.
Right.
I personally think it'll move further. But as interest rates in Japan start to move up, particularly if the US starts to cut rates, that dynamic completely changes. Because in absolute terms, US bonds may still be yielding more than Japanese bonds.
Right.
The directional change is in favor of Japan. And if you're a Japanese investor, right, your bias is to buy Japanese bonds anyway. So you only buy foreign bonds when the discrepancy is so great. So as the gap narrows and the change, the change of direction persists, I think Japanese will start selling US bonds, or at least when they mature, they will buy US bonds. So,
So
foreign buyers we shouldn't expect a lot of buying from foreign buyers.
So what happens if, let's say in the future, looking down the road, the next 6 months, interest rates stay the same, the debt servicing is out of control and keeps going up, and then let's say Japan does stop buying bonds completely and starts selling them, and let's say China just completely goes out with Russia. What happens to the U.S.? What happens to the U.S. dollar?
Right, right. Well, I don't think it'll be quite China will go to the same level as Russia anytime soon. But if we move in that direction, then the market, so you're left with who's buying US bonds, right? The Fed is allegedly reducing its balance sheet, so they're not a big buyer. The
Right,
Social Security Fund, which is another big buyer of US bonds, the Social Security Trust Fund is shrinking as we have more people taking money out now than
right,
putting money in.
right,
So the trust fund is shrinking. So although they'll continue to buy bonds, that's what they do with their money. They have less and less and less of it as time goes on. And even US banks, the regional banks, are a little cautious about buying bonds because of that whole mess with mark to market that we had, hold to maturity, but we had last year with the US bond, with the regional banks.
right.
And the investors that are buying bonds, whether they're hedge funds or whether they're pension funds or whether they're individuals, they will demand a higher yield. They'll demand a higher yield.
Yeah.
I mean, why would you buy? I don't know why anyone will buy a 30-year US government bond paying, what is it now, 4.5%?
Yeah.
When inflation is CPI is at 3.5 or something, but
And that's
most
and that's these numbers. If they go back to the 80s and 90s, how the way they calculated, it's like 7%, 6% or more.
so So people are just going to begin to demand, with fewer buyers, people are going to demand higher yields. They've already had several auctions, auctions of treasuries in the last couple of months that
Right.
have been very, very weak. And the 7-year treasury auction, 10 days ago, was excessively weak. And the dealers were left holding a lot of the bonds. Well, that means people are just going to demand, they're going to have to pay more to get people to buy. The other alternative, of course, the other alternative is that the Fed changes direction. They don't
Right.
have to lower rates, but they start to monetize the debt. And
Right.
I think that is a high probability. And that, of course, will be very inflationary, as we've experienced before. But I mean, that's the only answer. If people are not buying a debt and you have to raise rates to get people to buy, but you're trying to lower rates to ease the economy, right?
They're gonna have to monetize the debt. That's their
They're
only
gonna have to
option.
monetize the debt, yeah.
Yeah, absolutely. Well, Adrian, it's such a crazy time in history now, like especially everything that's going on in the markets, and not even only that, just in election time coming up in November and with the Fed.
Let's not talk about that.
Yeah, yeah, let's not talk about that, but it's crazy. But I want to thank you so much for coming down to Wall Street Silver and giving all of your knowledge to us. It's a huge, huge pleasure. And hopefully as the market develops, like in the next six to yeah, it's gonna be crazy, but as the market develops, we'd love to have you back on to talk
I'd love
about
to.
everything.
Thank you.
Awesome. Talk to you soon.